Okay, welcome to Module 15, and today we're going to talk about market multiples and other market-based valuation techniques, and basically what these market multiples and market-based valuation assumes that there's a certain rate of valuation that markets generally assign to certain factors, and it's usually only one factor. So what you would do is you would pick out some factor related to the company and see how the market values that as compared to other companies. You'll see in a moment. So the most common one is the PE ratio, price earnings ratio, which we will talk about. So this is module 15. And this is a very popular method. It is definitely the most popular method that analysts use to value stocks. And they describe it here as a shortcut, and it's a shortcut. It is work. It makes sense, and it's very simple, and pretty much everybody understands it. But there are so many shortcomings to it that you would not want to make investment decisions strictly based on market multiples. So the book goes into this. It says most common. The fact is that everybody does it the first way. So basically, using something like earnings or book value, investors will use earnings or book value as sort of an index figure, as sort of a basis for the entire company's valuation. And what the book tells you is that you want to look at company performance measure based on company value and a measure like NOPAT or NOA. And the latter method, which is the method of the book, is a method that very few people do because it's not so convenient. Earnings is something that everybody talks about and everybody plays around with, and you could look it up and get it really fast. And the NOPAT measure and the NOA measures, which the book talks about, are new. They're not printed by companies. You have to figure them out. And they're just not commonly used at all. That said, a NOPAT or NOA based valuation measure would be more accurate when you're going about doing this. But when people are using market-based valuation like this, they're usually not concerned with accuracy. It's just sort of a quick shortcut way of doing things. So when you go through the book, be careful, because the book, I think, overemphasizes its own method, which is better, but this is not how people do it. So step one would be to choose a summary performance measure, such as earnings, book value, NOPAT, or NOA. And the most common one is earnings and sometimes book value. And then select some comparable companies. And this is very tricky because for some companies, it's easy to find a comparable. And for other companies, there are no comparables. So if you're looking at a restaurant, you can compare it to other restaurants. But if you're looking at a large company that's in a lot of different businesses, then it's impossible to find a comparable there. And you compute the market multiple for all these different comparable companies' market values and performance measures. You'll see how we do it in a few minutes. And you'll do the same thing for your target company in step 4. If it's an equity performance measure, it's usually divided by the number of shares outstanding to equity value per share. And if it's a company performance measure, which is the book's method, you would subtract NNO, net non-operating obligations, and then divide by the number of shares. In other words, you would, for performance measures, which is the method of the book, you're going to look at the whole company. Then you're going to subtract the net non-operating obligations in order to get the equity, and then divide by shares. So there's that added step. And market multiples in general, you got to go over them because everybody does this. But it's not the best method, whichever way you use. I think the book's method of using company value is preferable, but it's not as good as the other methods that we've been talking about. And if you're playing with real money, then it's worth taking a few hours or even weeks in order to really value, in order to do a genuine forecast that you're comfortable with and figure out what you think the value is. So there's a lot of different measures you can use, and you can only choose, you could do them one at a time, but you're really only using one at a time. It's hard sometimes to find comparisons. And if you have several different companies you're looking at for comparisons, then you got to look at them separately. And it's hard to, you might have a lot of data points and not quite sure where your company is. But this is the most common method. In fact, in the old days, when I was a lad, the Wall Street Journal printed every company's stock price every day. So you could buy the Wall Street Journal and you could see what the stock price of that company was the day before. And we didn't have any internet to look these things up. Today you could just look them up on Google Finance or Yahoo Finance or wherever you're going to go. Anyway, so we would look them up in the newspaper, and the newspaper printed the PE ratio for every single company every day. The PE ratio, we'll talk about what that is. That's a market multiple. So that's how important PE ratios have been, because it's just a standard thumbnail shortcut that investors universally use in order to quickly try to figure out if a company is undervalued or overvalued. That granted, it relies strictly on earnings and ignores a ton of information. So let's talk about balance sheet multiples to start off. This is balance measures, sheet measures, okay? Here we go. We're looking at Dollar Tree and Dollar General and Big Lots. And I don't know if you're familiar with this. I never went to any of these stores until fairly recently. My friend, we went camping and we went to Dollar Tree, and I was like, wow. So I couldn't believe that everything in this store is $1. And there are things that in other stores cost several dollars. And you go to Dollar Tree and it's just $1. I've never been to Dollar General or Big Lots, but there's similar kinds of stores. Anyway, actually I think Dollar General and Dollar Tree might have merged. I'm not sure. Anyway, let's look at Dollar Tree for a second. And we're trying to figure out the value of Dollar General's equity. So we've got Dollar Tree and Big Lots, and the numbers we have here are the assumed value and for the entire company, and the equity assumed value. And these are both based on market values. So to derive, say 25, let's start off with equity. To derive 19,108, that's the market value of the stock. That's the number of shares of stock outstanding times the stock price on whatever date we're talking about here. The company assumed value is that plus the intrinsic value of all the debt. So if there's bonds payable outstanding, it's the market value of those bonds plus any other liabilities. Then we have net operating assets in the financial statements. We have book value of equity, that's just total stockholders' equity on the balance sheet. And we have net non-operating obligations, NNO, which we've talked about. That is the net of all the not operating assets. So in other words, what you would do is you take the non-operating liabilities and subtract the non-operating assets in order to get that figure. And then we have the number of shares. So let's start off with NOA. And again, this is a preferable method, but it's not the more commonly used method that everybody's using. For Dollar Tree, we figure out the net operating assets are $11,001. The total to calculate the net operating asset market multiple, we would take the company assumed value based on market value of the stock market value plus the value of the liabilities, and we would divide by the amount of net operating assets, 11,001, and we get a market multiple of $2.34. So Big Lots, the other competitor, is $2.63. Therefore, the average of that would be $2.49. And now we can use that to figure out what the market value per share of Dollar General should be. So $2.49, if they have net operating assets of $8,191, times 249 would give you intrinsic value of 20,396. And subtract the NNO, and you get equity intrinsic value of 17,583, divide by the number of shares, and you get equity intrinsic value per share of $61.33. So here you can see the whole calculation written out for you. Net operating assets of Dollar General of $81.91 times this valuation of $249 means that the whole company has an intrinsic value of $20,396. And then if you subtract from that the NNO, so 20,396 minus 2813 would give you the equity intrinsic value of 17,583. And so the intrinsic value per share of 17,583 divided by the number of shares would be $61.33. Again, this is the method of the book. It's an accurate method, but it's not as commonly used as the following method. This is book value multiples. What book value multiples would do is they would take the book value of the equity and compare it to the total market value of the equity. So the first line here, equity assumed value, is the total market valuation of the company stock. And then the second line is the book value from the balance sheet. And there are 235 shares outstanding at Dollar Tree. So if you divide 19,108 by 4407, you get book value market multiple of $4.34. Big Lots is only 264. The average of those is 349. And you multiply that by the number of shares, 286.7. But I know what I'm saying. So you take the book value of the equity, 5,378 rather, and you multiply it by the market multiple of 349, and you get 18,769. Now, if you divide that by the number of shares outstanding, then you'll get intrinsic value per share of $65.47. So if the actual stock price is $75.06, then this would indicate that it's not worth it, because the value here is $65.47. And we get a similar result here using NOA, $61.33. It's a little lower. $65.47 based on book value. $61.33 based on our net operating asset model. But either way, it's not a good investment because the stock price is $75.06. And you don't have to necessarily use balance sheet value, book value, but rather you could also use profitability, growth, or risk measures. But the problem is you can only do one thing at a time.